Okay, so let's start, and we are going to start off discussing first of all the various examination questions pertaining to IAS 16 property plant equipment. Mukhtar, yes, I owe you people. I need to send across the IAS 19 answers. Don't worry, I'll do them by tomorrow. Okay, so let's start off. Let's start discussing. First of all, we are going to start off with IAS 16 property plant and equipment. And what I'll do is that I'll have a quick recall of IAS 16 property plant equipment. If I could have a quick recall of IAS 16 property plant equipment. So what exactly is a property plant and equipment? A property plant and equipment is a tangible item, which is expected to last for more than one accounting period, which is more than 1 year period. And what happens is that it is held for use in production of goods, held for use in production of goods, for the rendering of services, and for the administrative purposes. So what exactly do you mean by the property plant equipment? The property plant equipment is a tangible item which is expected to last for more than 1 year. It is held for use in the production of goods, for the rendering of services, for the administrative uses. A property plant equipment is initially recognized at cost, and the cost of the property plant equipment is it includes purchase price. It includes directly attributable cost and includes the dismantling cost. When we move a bit forward, so we can talk about the subsequent measurement of the property, plant and equipment. With respect to the subsequent measurement of the property, plant and equipment, you have got a choice that you can measure the property, plant and equipment under the cost model, or you can measure them under the revaluation model. When we talk about measuring them under the cost model or the revaluation model, so there is something that you have to keep in mind. That is that all items under the same class to be measured using same model. So that is like, for example, if you want to have land and you want to carry a land at cost model, so all of the land have to be carried under the cost model. If you have got a building which you need to carry under the revaluation model, so therefore all the buildings need to be carried under the revaluation models. That is something that you would have to keep in mind. So when it comes to the subsequent measurement of the property, plant, equipment, the subsequent measurement of the property, plant, equipment is such that you can measure the property, plant, equipment using either the cost model or the revaluation model. What is the cost model? The cost model is that you have got the cost less accumulated depreciation, less accumulated impairment. So if we apply the cost model, what happens is the cost less accumulated depreciation, less accumulated impairment. And when we apply the revaluation model, it's a fair value less subsequent accumulated depreciation, less subsequent accumulated impairment. So this is what it has. The revaluation model is fair value less subsequent accumulated depreciation, less subsequent accumulated impairment. Now let's move a bit forward and let's discuss further. When we talk about the depreciation of the property, plant and equipment, so what happens under the depreciation is you spread the depreciable amount of an asset. You spread the depreciable amount of an asset over its useful life. Over its useful life. Always remember, we use the useful life. The depreciation, it commences when the asset is available for use. When the asset is available for use. Irrespective of whether you have started using the asset or not, the depreciation will commence when the asset is available for use. Well, Osama, I mean, like I've just started. You have not missed out anything. Okay, the depreciation is going to commence when the asset is available for use. Now, will the depreciation be suspended? The answer is the depreciation would not be suspended. Irrespective of even if the asset is held idle, the depreciation would not be suspended. The reason being, once the asset is available for use, the depreciation would start. And once the depreciation has started, it would not be suspended. Let's move a bit forward. At times, what happens is you have got a complex non-current asset with you. What do you mean by complex non-current asset? An asset which is made up of multiple assets. An asset which is itself made up of multiple assets. So if you have got an asset which is itself made up of multiple assets, that is going to be considered as a complex non-current asset. What are the examples of the complex non-current assets? So amongst the various examples of complex non-current asset, we have got a ship, we have got an aircraft, we have got a factory. These could be considered as an example of the complex non-current asset. If we talk about an aircraft, so the interior of the aircraft have got a different life. The engines of the aircraft has got a different life. The exterior body has got a different life. When you talk about a factory, so at times what happens is the machinery might have a different life. The building has a different life. The furnace might have a different life. You talk about a ship, the hull, which is the outer body of a ship, has got a different life. The engines have got a different life. The propeller of the ship has got a different life. So, and the interior of the ship, it has got a different life. So if you've got assets, if you've got assets which are themselves made up of multiple assets, so what do we call them? We call them complex non-current assets. What do we call them? We call them complex non-current assets. So if you have got complex non-current assets, so what you do is that you depreciate each part. You depreciate each part of a complex non-current asset separately. What do we actually go about? We actually depreciate each part of the complex non-current asset separately. That is, for example, if you have bought an aircraft, let's say if you bought an aircraft for, let's say, $40 million, then the first thing that you're going to do is that you would allocate the cost of this aircraft to the exterior body of the aircraft, to the interior of the aircraft, to the engines of the aircraft. This is what you're going to do. What? Exterior, interior, engines, etc., etc., etc. And when you are going to be when you are going to be when you are going to be allocating it, may be possible, let's say I say $10 million, I say $5 million, and maybe I could say $25 million. And what would happen is there would be a different estimate of the life. Maybe it could be considered as 10 years. Maybe it could be considered as 5 years. Maybe it could be considered as 20,000 flying hours. So there could be different types of lives. So what you would do is that you would depreciate this over the 10-year period. So this $10 million divided by 10 gives you $1 per year. This is again $5 divided by 5 year gives you again $1 per year. And this is 25 million divided by 25,000, 20,000 flying hours would give you something else. So again, it was million. So you've got 25 million divided by 20,000. So this is actually going to be $1,250 per flying hour. So let me repeat, what happens is when you have got a non-current asset, which is a complex non-current asset, that is, the non-current asset is itself made up of multiple assets, then you depreciate that asset by allocating the cost to the different components of that asset. The next thing is, when we talk about the concept of revaluation model, So what happens under the revaluation model is, first of all, if you have got a revaluation gain, this revaluation gain is recognized in OCI. If you come across a revaluation loss, the revaluation loss is initially offset against the revaluation reserve. And in case if there is any balance loss that is left, that balance loss is allocated to the P&L. In case if there is a subsequent gain, so first of all what happens is it should reverse loss recognized in P&L. So assume that you had an asset on which no gain and no loss existed. And if there is a gain, so it would directly go into other comprehensive income. In case if there is an asset on which the loss arises, so first of all, this loss would be allocated to revaluation reserve and any balance amount would be allocated to the profit and loss account. If there is a subsequent gain, I repeat, if there is a subsequent gain on this, if there is subsequent gain on this specific revaluation model, what should happen is that it should reverse the loss which is previously recognized in the P&L. Is there a limit? Is there an extent to which the loss can be recognized? Yes, there is an extent, there is a limit to which the loss could be reversed. That is, the carrying amount of the asset should not exceed. Carrying amount should not exceed the depreciated historical cost. Carrying amount should not exceed the depreciated historical cost. What exactly do you mean by the depreciated historical cost? So depreciated historical cost is the carrying amount computed on the assumption that the asset was never revalued. I hope that I'm not going very fast. It's just a recalling. I'm trying to revise the standard. I hope that I'm not going too fast. So what actually happens is that when you have got to reverse the gain in the P&L, so there is a maximum limit to which you can reverse the gain. That is, you can reverse it to the maximum the depreciated historical cost. And what is that depreciated historical cost? The depreciated historical cost is the cost or the carrying amount of the asset had there been no revaluation. Had there been no revaluation. So this is going to be considered as what? This is going to be considered as your depreciated historical cost. Now, so this is a general measurement with respect to the cost model, with respect to the revaluation model. If I talk about the derecognition of the property, plant and equipment, if I talk about, okay, Ademola, Adel Hussain, just wait a bit. I'm giving a practical illustration to this. Just wait a bit, it will be illustrated. When it comes to the derecognition of the property, plant, equipment, an asset should be derecognized. An asset should be derecognized at the earlier of date of disposal or when no future economic benefits are expected to flow. So basically what happens is if the asset is not expected to provide any economic benefits in the future, that means it's of no use. Even if you have not even if you have not disposed it off, you're going to derecognize it. I repeat, even if you have not disposed it off, you're going to derecognize it. So what are we actually looking at? We're actually looking at the derecognition of the property, plant, equipment. When do we actually have to derecognize the property, plant, equipment? The property, plant and equipment have to be derecognized when, I repeat, the property, plant and equipment have to be derecognized The property, plant, equipment has to be derecognized at the earlier of the date of disposal or when the future economic benefits are not expected to flow. Is that okay? Now, yes, the asset has become obsolete. The asset is of no use. So that's when you are going to be derecognizing it. So this is generally something that we have covered up with respect to the recalling of IAS 16 property, plant and equipment. The objective was that we have a quick recall of what a property, plant and equipment is and how the accounting is done. Now, you have in front of you the different question extracts. There are no requirements mentioned into this question. There are no requirements mentioned on these questions. So all that you have to do is that you don't have to worry about it. You just have to account for it to whatever possible extent that you can. So the first thing that we are going to do is we are going to be talking about this question, the name of which is Ashanti. Kindly go through it. I'm giving you 2-3 minutes to do the relevant accounting, and then I'm going to start discussing. Now, let's just start discussing about this question. It says Ashanti owned a piece of property, plant, equipment which costed $12 million and was purchased on 1st May 2008. It is being depreciated over 10 years on the straight line basis with a zero residual value. On 30th April 2009, it was revalued to 13 million, and at 30th April 2010, the PPE was revalued to 8 million. The whole of the revaluation loss had been posted to the SOCI, and depreciation has been charged for the year. It is Ashanti's policy to make all necessary transfers for excess depreciation following revaluation. Now, what exactly are we going to do? How exactly are we going to account for this? So let's try to have a discussion. So if I talk about this Ashanti, first of all, the starting date is 1st May 2008. The starting date is 1st May 2008, where it's actually what, $12 million. So you've got $12 million as the cost. There is actually going to be a depreciation. What happens is 12 million divided by 10. So 1.2 million is going to be the depreciation. $10.8 million is going to be the carrying amount at 30th. At 30th April 2009. At 30th April 2009. Now what happens is there's going to be a fair value and the revaluation would be $13 million. So the revised fair value is $13 million. So that means there is going to be a gain of $2.2 million. How would we account for it? I'm just going to come back to it. So at 30th April 2009, this is going to be the gain that would arise. Now what happens is after this, on the 1st of May 2000 and sorry, after this, so what happens is the revised carrying amount at the 1st May 2009 is going to be 13 million. The depreciation for the year is going to be 13 divided by now. Originally it was a 10-year life. Now there is a 1 year consumed, so you're now left with 9 years. So what are you going to do? You're gonna divide it by 9 years. You're gonna divide it by 9 years. So when you will divide it by 9 years, so resultingly 13 divided by 9 is going to be 1.44. Resultingly, the net book value at 30th April 2010, the net book value at 30th April 2010 is going to be what? The net book value at 30th April 2010 is going to turn out to be 11.55, 11.56. And we now know that there is a fair value. And what is the fair value? The fair value is $8 million. So there is actually going to be a loss, and the loss is going to be of what? This 11.56 less 8, a loss of 3.56 million is to be recognized. Now, How exactly are we going to be accounting for all of this? Let's try to have a discussion on this. Now see, what happens is, how exactly are we going to be accounting for all of this? I'll pass on the double entries so that you people understand. This is one accounting year. This is another accounting year. This is whole another accounting year. So I'll pass on the double entries for all of them so that you do know that how to account for them. At the 30th April 2009, we are simply going to do this thing. The depreciation expense is going to be debited by 1.2 and the accumulated depreciation is going to be credited by 1.2. And when we have to recognize the revaluation, so there is, I mean, like what you could do is that, because a lot of students, what they do is that instead of writing accumulated depreciation, they directly say the non-current asset. So even if you do it this way, that doesn't matter because our examiner does not requires double entry from us. All that he generally requires is that he requires the discussion, he requires the narration. So it's okay as long as you are able to understand the concept. And when there is going to be a revaluation, the revaluation is going to be recognized like this. The revaluation reserve would be presented in OCI 2.2 million and the non-current asset is going to be debited by 2.2 million. This is what the accounting entry is going to be. Okay. Amina, you have joined right now. I revised IAS 16 property plant equipment. I did the whole revision of IAS 16. And after going through the IAS 16 revision, I've shared the compiled questions on the non-current assets in the WhatsApp group. So I've started discussing one of the adjustment pertaining to this question, Ashanti. And this is what it is. This is the part that we are doing right now. So it's actually going to be non-current asset debited by 2.2 and the revaluation reserve is going to be credited by 2.2. Now what happens is at 30th April 2010, there's going to be one entry pertaining to the transfer of revaluation reserve to retained earning. How much is that going to be? It's the revaluation reserve divided by remaining useful life. So 2.2 million was the revaluation reserve. Was that? Yeah, 2.2. And you have to divide it by 9 years. So how much is that going to be? 2.2 divided by 9 years gives you 0.2444. Gives you 0.2444. So what actually happens is you'll find this double entry, which is the revaluation reserve is going to be debited by 0.244 and the retained earning is going to be credited by 0.244. The second thing is that there's going to be another entry which is going to be about the depreciation expense. You would say the depreciation expense is going to be debited. How much is it going to be debited by? We've already calculated it, 1.44. And you would simply say the non-current asset is going to be credited by 1.44. Now the third entry that is going to happen is that you have a loss on the non-current asset of 3.56. There's a revaluation downward of 3.56. We'll have the revaluation reserve debited and we'll have the P&L debited. By how much amount the revaluation reserve is going to be debited? So the total revaluation reserve that arises was 2.2. Out of this, 0.244 was actually transferred to the retained earning. So hence 1.956. 1.956 is the revaluation reserve that is remaining. And if you have got a total loss of 3.56, 1.604 is going to be recognized in the P&L. So this is what is going to be recognized. I repeat, this is what is actually going to be recognized. Now, what am I going to do is that I'm going to zoom out. A lot of you people, initially when I actually asked you people to do the question, a lot of you people told me that you have done this question. So you're done with the question. So I just want to know that if you were done with the question, was that how you actually accounted for this question, or was that a different way that you accounted for this question? Okay. What I'll do is that I'll just zoom out. I'll just zoom out so that every one of you can actually see. It's going to become a bit of a microscopic, but the whole of it is going to appear in the single screen. The whole of it, in fact, it's not appearing. I'm really sorry about it. But do see that in case if you're okay, just wait. Just wait. There is a question, Rosiru, you're asking why are we not adding the revaluation gain to OCI? Okay, we are doing the revaluation gain to OCI this much here. See, the revaluation reserve of 2.2 was added to the OCI here. Not with entry. Okay, Adil Hussain, because entries are important to understand. Mukhtar Khan, you forgot to transfer. Okay, just look at the question. It specifically says that the entity does the maximum transfer. It is the policy to transfer the maximum to the excess depreciation. Ismail Sharif, you please go over the revaluation loss again. Okay, I'll go over the revaluation loss. You see the asset was 13 million at 1st May. The remaining life of the asset was 9. So 13 divided by 9 is 1.44. So the remaining carrying amount is this much, the fair value is this much, loss is this much. Now, how exactly are we going to recognize the loss? So the first thing that we had to do was there was a transfer of revaluation to retained earning. So the transfer of revaluation to retained earning was like this: 2.2 divided by remaining life 9. So 0.244 was transferred. Then we recognize depreciation expense. And now the non-current assets value has to reduce by 3.56. The value of the non-current asset has to reduce by 3.56. The revaluation reserve is going to be debited by whatever that is left. So originally it was 2.2. Then there was a transfer from revaluation to retained earning of 0.244. So that means revaluation has decreased and it has now become 1.956. The P&L is going to be debited by 1.604. What is it? This is the balancing figure. Okay. There is a question by a student, Bongi. She's asking that the transfer of revaluation, is it always transferred to retained earning? Is this the preferred treatment? Okay. I can guide you in case if there is a depreciable asset, you transfer it to retained earning. In case if there is a non-depreciable asset, you do nothing. In case if it's a non-depreciable asset, you do nothing till the time you dispose of. The revaluation reserve actually gets transferred to the retained earning, but only in the case of the depreciable asset that you would keep on transferring on a regular basis. But in case of non-depreciable asset, you would not be doing it. Okay, Adil, as long as you are getting it, so that is okay. Imran Makbul, if the transfer is not done, you just mark out that you have actually made an error here and don't try to repeat the error again. Ademola, why are we transferring to retained earnings? Okay, let me explain to you why exactly are we transferring to the retained earnings. Okay, let me explain to you this thing, that in case if you've got an asset, I repeat, in case if you've got an asset under the revaluation model, I repeat this thing. So in case if you've got an asset under the revaluation model, so one thing that you have to do is that the revaluation reserve, whatever the revaluation reserve is, it has to be transferred to retained earning. But when? So generally is either like this, either upon derecognition of asset or as the asset is consumed. So it's actually going to be either upon the derecognition of asset or as the asset is consumed or utilized. So I repeat, the revaluation reserve is transferred to the retained earning as soon as the asset is consumed. So what do you mean by the asset is consumed? It's basically that the asset is utilized, you keep on transferring it. Adil, they are all past examination question. Yes, they are from the P2 paper. I mean, what I've just picked out is the adjustments from the different questions. It was part of one of the consolidation question named Ashanti, and this was one of the adjustments in that consolidation question. Edimula, I hope you are okay now. And the rest of you people, are you all okay with this? Rest of you, are you all okay with this? Okay, this is good to hear. Now, so let's move a bit forward and let's discuss further. So we are done with this one of the adjustment which was pertaining to Ashanti. Okay, Zivi Komborero. Zivi Komborero, where are you struggling? Just let me know so that I can clarify, so that it does not keep on recurring again and again. Let me know which area are you struggling with. Your name is, I hope I'm pronouncing it correctly. Your name is Zivi Komborero. Okay, point three, Muhammad Rikshan. Point three, this one, right? Okay, let me explain to you. What happened is there was a revaluation reserve of 2.2. You have transferred the revaluation reserve to retained earning of 0.244. Resultingly, 1.956 is the balance on revaluation reserve account. So if there is a balance on revaluation reserve account of 1.956, and if we have got a total loss of 3.56, so what happens is this 3.56 loss is going to be allocated to the revaluation reserve of 1.956. The balance amount of the loss is going to be allocated to the P&L, which is going to be whatever the balancing figure. And that balancing figure turns out to be 1.604. So this is why we have passed on this double entry. Do you get it now, Muhammad Rikshan? Do you get it now? Okay, why do we transfer this? Because I just told you the treatment that the revaluation reserve has to be transferred to retained earning. When to transfer? So I told you if there is a depreciable asset, you need to keep on transferring as soon as the asset is consumed. So the asset kept on consuming, 9 years was the life. 1 year's passed, I transferred the 1 year related depreciation. Retainer, there's a revaluation reserve. Yeah. Are you all okay now? Okay, good enough. Okay, thank you.